Okay, everyone. Thank you, team. Alex, welcome back to F.A.C.E. How are you, buddy?
Hey, Dale, how you doing? Can you hear me?
Yeah, got you.
Got me loud and clear? All right.
Loud and clear. Do you want to share your screen?
Sure.
Okay. What's on the radar, buddy? With the Fed and yesterday.
Yeah, let's I just put together a little chart deck this morning that I could run you guys through some things that I'm looking at.
Thanks for the effort.
Yeah, but I got a question. Was that a life-size model of Boba Fett that I saw behind Blake Morrow in that video?
Yes, it was.
Man, that's sweet.
So Alex, and good morning, and thanks for joining us. I'll tell you just real quick story. My teenage kids at the time were teenagers. They're like, this is when Star Wars, several years ago when they started the whole new series, and they're like, Dad, what are you gonna be for Halloween? I said, you know what, I'm gonna build, because they love Star Wars. I'm gonna build a Boba Fett costume. They're like, yeah, sure. And I'm like, no, I'm really gonna build one. I'll build one for you guys. So yeah, it took me like 2 years to build it, and then I wore it during COVID for Halloween, and went around the neighborhood with Boba Fett. And I'll tell you, I'm 20 pounds too heavy. I'm not my ex-military weight anymore. So Boba Fett was like kind of chubby Boba Fett.
Bring it to the tailors. I'll let it out for you.
Anyway, that's the story. All right. Hey, thanks for joining us, Alex. And
good eye, Alex. Good eye for costumes. How about markets here, buddy? I'm still not seeing your screen.
You're still not seeing the screen? Let's see.
Yeah, click that green button.
Yeah, share screen. Okay. There we go.
There we go.
You got me?
All right. Yep.
Okay. All right. So the name of the game for us, we're a little bit, I think, longer term focus than you guys, a little bit. A mix between investing and trading. And so since the end of last year, our kind of MO has been for a volatile sideways regime in the market. And that's the best that we can hope for, which luckily has mostly played out. And so I'm just going to walk you through kind of like we'll start at the 30,000 foot and, zoom in down to the Nat's ass level and just kind of give you a scope of what we're thinking about. But so just here's our just kind of bread and butter macro ops growth composite model. It's just composite of 13 different indicators that look at the economy on just straight data metrics, financial metrics, liquidity metrics, and some relative market moves. And so we've been in kind of a slowdown regime for the last 6 months or so. You could see that over here.
Average is peaked in Jan.
Yep. And nothing surprising there. It's still, elevated well above the zero line, which is, where you get into kind of, recession concerns. So there's that, just another way of looking at the Conference Board leading economic index. Again, it's coming down, but from very high levels, it's still elevated. So, we've been seeing a lot of recession risk, talk about yield curve inversion over the last 6 months. That is not a concern for ours at all.
A lot of people, Alex, since you bring that up, the inversion, a lot of talk about the great steepening to be the next play. Do you agree with that?
I think it's possible. We've been really focused on not having strong opinions and opinions that we do have, holding them very weakly, just because we are probably in the most noisy macro environment we've been in our lifetimes.
Well, how old are you?
38. So
I
have a couple.
You've only seen what, 18 years of market history? Huh?
Yeah.
And you're talking about a lifetime?
Yeah. Well, I would
no,
say
you're very experienced compared to a lot of people out there. I'm just giving you a hard time.
I would say as a student of market history, it's probably
there you go.
It's probably up there with even the ones that you've been through. But that's just speculation on my part.
The panic in 1908 was pretty wild. But
I'm sure you have a lot of stories from then. All
Go
right.
ahead.
Okay, so the LEI is coming down, but from high levels. Still, again, not a ton of recession risk, but historically, this is one of the worst macro environments for just equity returns, which you can see here.
Yeah.
Generally, it's about flat to negative, depending on the regime. Here's our recession probability model. Looks at the probability of a recession going out over the next 24 months. It's a Probit model with 13 indicators that looks at everything from corporate profit margins to investor leverage in the markets to hard economic data and so forth. Again, a recession isn't going to happen. So generally, I mean, this is just to build context, right?
I like it.
Going through everything. Here's our bear market probability shock. So you can have a bear market without a recession. They're rare, but they occasionally do happen. And as we can see right here, it's very elevated right now. And this is looking at things like rate of change and interest rate moves. War is not directly a factor in this model, but it's definitely moving the variables like inflation, the rate of change in inflation and interest rates. So that is the big macro takeaway. Here we have our inflation model. What we can see, this is different leading inflation indicators. The blue line is our leading inflation composite indicator. It's peaking. We could see that in the sub indices right here, but there's still some variables that are moving higher. And so, our call is we probably would have seen inflation. We definitely would have seen inflation peak in Q1 of this year. The Russian invasion that definitely, threw a wrench in those gears and has changed that. Our call is still that we see inflation, especially the Delta, come down, but it's probably going to remain elevated, until, it's just like, again, it goes back to the difficulty of this macro regime. I mean, you have tons of ships sitting off the coast of China because of their lockdowns. It's screwing up supply chains.
That's intentional.
It could be, yeah. It could be. There's definitely some credible theories going around about why that is. And then obviously everything that's going on with Russia and Ukraine and how that's affecting fertilizer and the ag market and stuff. Okay,
that's intentional too.
Yeah, you could be right, Dale. You could be right. I mean,
everyone wants to see the king taken off the throne. It's always like that, right? Yep. So just call me Elvis. Anyway, Alex, so these are interesting because a lot of people think when people say inflation has peaked, that it means prices are going to go down, and it just means a rate of change of inflation continuing to accelerate is peaking.
Right? And that's like a big, that's an important takeaway, right? I mean, everybody's focused on the level, but mostly in financial markets, it's the delta, the rate of change of what we're looking at that matters, because the level is already priced in. That gets embedded quickly. And that's especially true when looking at inflation. We're not so much concerned about the level. We're concerned about the rate of change of inflation. And so we think that, we've seen the peak in the rise in inflation. We're going to start to see that delta come down. So, generally, that's kind of the broad macro view is, okay, a recession is not going to happen. Very, very low probability. So, you could just ignore a lot of the doomsday or recession callers out there. A bear market, a 20% decline from the peak is very possible.
Haven't we had that in many areas of the market, and even
right?
more?
Yeah, and that further kind of convolutes the broader picture, right? Is because you've had massive growth names just get kneecapped, right?
Yeah.
Right. And so that's happened over the last 18 months. That hasn't been recent, even though that's kind of continued. So a lot of the air has already been taken out of this. I don't think there was definitely some pockets of the market that were bubblish territory, but that air has long been taken out. So I think we are getting closer to a major bottom in the market, and that's our general call. But we still need to see, for me to get comfortable saying that we're there, we need to see that kind of final washout, capitulation, liquidity reset. See see yields find a ceiling and stabilize. This is like the slide I'm showing you now. Liquidity, we look at it a number of ways, but like the rate of change on high yield debt, on BAA yield, the spread on LQD, IEF. So I mean, all this stuff it's just liquidity has tightened up too quickly, and that's what's been weighing on markets. And so we need to kind of I'd like to see a flush, maybe one more leg down and then a big reversal, and that would make us more comfortable. But until then,
we could have had that flush yesterday if Powell did not make the comment that they're not going to be more aggressive than.
Yeah, to be honest,
it was right on the cliff. It was right on the cliff.
Yeah, and I think he probably would have been better off if he wouldn't have done that. I don't think he's doing himself any service by slow walking this thing, because he's been
a dove
behind
in hawk's clothing.
Yeah, no, I mean he really is, and he's been chasing the market for the last 12, 18 months, and so you would think that he would err on the other side finally.
Yeah. See, that's your net. It's he went back to his default position. What about all the wealth that's been decimated and destroyed in sovereign bonds, in the junk bond market, in the corporate bond market, in the muni market? Do you see any, like credit events in your, say, binoculars or telescope down the line with, how leveraged everything is, and this rate of change in rates, even if they're peaking here, could set off?
Yeah, so certainly, right? I mean, I was looking at a report that Bank of America put out the other week, and they were, showing essentially like the global aggregate bond and credit market has seen their worst, I think, rolling 6 or 12 months since 1920, and so
no one's talking about it.
Right. Yeah. And so that's significant. Typically that what we see happen in like big moves like that in the bond market, they tend to have a long lead time on the rest of the market. And so can that show up in a further, liquidity
6
pocket
months.
kind of down in 6 months? And I think definitely, I think you're spot on, Dale. But I would say, it all depends on the reaction function of the game masters, Powell and his team and the other central bankers, and how they react to that data when it comes in. If they're all doves in hot clothes, which I kind of suspect we are still in a new policy regime, and that we're seeing a lot of tough talk, but I don't think that many of these game masters are willing to do the actual work to reverse their errors. So here we are. But
I just think that's a big story people aren't talking about, and and the extremists are talking about like sovereign debt crisis. The biggest buyer is no longer buying.
Yeah, I'm not too concerned about that. I mean, I think it's on a case by case basis. I think it depends on what country we're talking about. On the US, I'm not too concerned, just because the entire system is still very much structured around holding dollar. US treasuries, and the dollar is the ultimate safe haven asset. So we're a long ways off from that.
That worries me. Everyone thinks we're safe. So trend fragility is low.
Trend fragility is low. Again, this is just a composite indicator of different sentiment, positioning, and flows. But we could see it hasn't hit the capitulation levels that you typically see at major bottoms. It doesn't mean the market can't rally back up near the highs. I mean, that would be very typical of a sideways volatile regime. But this is just another sign that I don't think we're yet at a durable bottom, but we're getting close. Sentiment and positioning, here's just some of the parts of that indicator. We've seen hedge fund positioning really come off over the last week, which is interesting, and we're getting close to kind of what you see at the different lows. Aggregate US equity fund flows, again, getting close to that green line. This is where we see capitulation. Everybody's been talking about AAII, net.
Right.
sentiment. Yeah, that's been very bearish. So that's a one of the preconditions for a major bottom, but it's not like a catalyst for one, right? So we need to see these other things. Put call ratios are still relatively elevated, and then same with name average equity exposure. So again, this is just kind of this suggests that we're getting closer to a larger durable bottom in the equity market, but we don't have the capitulation for one yet. So just something to keep in mind.
Could that have been a bottom, enough of a bottom to propel the market to new highs from, say, the Monday's low? That reversal, false breakdown under 4,100. I know a lot of people are looking for that 90%. What is it, volume or breadth down?
Yeah,
the swoosh. But maybe we haven't had it because we haven't peaked.
Right. And so, I mean, in markets, anything is possible. We're just concerned with what's probable. I think, we're definitely at the lower end of the range near major support. We saw an over 8, I think it was an 80% upside volume day yesterday in the, exchange. So we'll have to see if we see, we've seen plenty of those year to date, but we haven't seen the second consecutive follow through day, which you need for a classical breadth thrust.
Okay.
So we'll see if we get one of those today. So right now we're just kind of, playing in, we've been a lot more short-term focused than we typically are year to date. So just playing for, short-term swing trade. So yeah, we're buying little bits right here, to see if, just playing for like a move up towards kind of maybe the middle of this long-term sideways regime. If we get a breadth thrust, like if we get that confirmation today, then we'll get more aggressive to the long side. So yeah, here's just kind of the chart I'm looking at. This is just the cues. I'm seeing major support at the 1200-ish level around there. Again, like if we got a washout down there and then a reversal, that would make me a lot more excited to start aggressively buying, because there are some, especially in, I think the growth names are getting really interesting from a positioning sentiment standpoint. And if you have to dig in, because there's still a lot of just total garbage, really bad business models, but there are a lot of really good names trading for 7% free cash flow yields, growing upwards of 20%. Revenue growth.
I like that chart too, Alex. Would you wait for some green to start showing up? I mean, even yesterday on the bottom, you don't see any green.
Yeah. So this is the SQN market regime model. It was developed by Van Tharp, and so we use it to identify what regime the price action is, and it works for any asset class, right? So right now it's been in a bear quiet to bear volatile. That's what these red bars see. And typically the best returning regimes for the long side are bear quiets, which is the light green. So yeah, we would like to at least to see it to move into neutral. Again, that's just another technical indicator we look at, be like, okay, now I think the trend price action is changing, the feel and tone of price action is changing. It's a lot more favorable to the long side. Again, this is just our breadth thrust page, something we check in every day. We can see here, we got oversold conditions in the McClellan oscillator, percentage above 20 and 50 day. So we got preconditions for a very temporary low. Boom, buy, add a little bit yesterday, today. You could nestle in stops right below yesterday's low. But we want to see now breadth thrust. We want to see that second consecutive 80% plus upside volume day to day. We want to see, get a broader MACD buy signal. Again, we want to see these spike. We haven't seen those yet. Sectors that we've been focusing on, we're just looking at what's working, where's the trends working, both on a fundamental basis and technical basis. We like to look at forward relative earning per share trends. It's not rocket science. Energy has been the clear winner of the last 18 months, so we've been heavily focused there. Materials are still doing really well. Surprisingly, the relative earnings trends in semiconductors are actually holding up. So that's something to keep in mind. I know AMD just reported the other day, and they put out good numbers. And Infotech is holding up. So I know you guys like to focus on currencies. We wrote up the long case for going long the dollar versus the renminbi a couple weeks ago. That ended up breaking out. Yield differentials here are back in favor of the U.S. dollar, to the greatest degree since over a decade. So that's really interesting. The dollar, I just think that this is,
is this a breakout here, Alex?
Yeah, I actually think it is a breakout. So we're long the dollar, and it's extended on a short-term basis. But you just look at the price action relative to the narrative that we've been seeing, about the dollar losing its global reserve currency status.
Yeah.
And so obviously there's, the narrative is not matching what we're seeing. So like we're long the dollar. We've been taking a little bit of profits here. We'd like to wait for a pullback to the midline of the Bollinger Bands on a daily.
Long-term outlook, targets, objectives on this chart?
Yeah, just going off of measured move target off of this larger monthly pattern. Right. That gives us a target of 115. On the trade weighted dollar. So I think that's very possible. And then especially like you look at what's going on in the world. Well, Russia has really hurt the emerging market trade. And then what China's been doing to its tech sector and with its zero COVID policy, that's a big weighting in the emerging market indexes, right? And so that really hurts the emerging market trade. It's going to hurt the growth in the rest of the world. So if you're looking at everything, right, you have to look at everything on a relative basis. Well, the U.S. is starting to look better and better. Now, I think I heard Blake talk about some of the strength in some of these select EM, currencies and stuff, and that's definitely true. So it's a case by case basis. I think Mexico and Brazil are very interesting. Mexico because it's going to be a long-term secular beneficiary. People moving their manufacturing closer to home as we move to away from globalization to regionalization. Brazil, obviously, because it's a large agricultural exporter, commodity exporter, so they're going to benefit. But EM as a whole, look, U.S. did the largest fiscal impulse of the group. Our growth is our economy is going to stay stronger, but it's also mean that the Fed's probably going to be on a longer term tightening path. That's going to continue to put the squeeze on the rest of the world, especially these emerging markets broadly are going to be out of favor for a while. So I think there's a real chance we move back into kind of a reflexive loop over the next 1 to 2 years, where we see these capital flows come back into the U.S., back into these certain growth names with better fundamentals, and we see that higher dollar, higher U.S. versus rest of the world equity performance that brings down inflation a little bit, and that kind of maybe we get a positive reflexive loop there. So that's just something I'm thinking about. And then I just end with this. Quote that I shared with people the other day is that a lot of guys, especially longer term guys, have been getting chewed up year to date because they've been trying to play the same game they've been playing the last 5-6 years. You have to be flexible. You have to know what market regime you're in. And if you're kind of a long term position guy, if you move into a sideways regime, then it's okay to sit on your hands, not be active. Wait for the setup that fits your process.
Patience pays. Sometimes the right trade is no trade. Alex Barrow and Jesse Livermore. Really important thing for people to learn is to sit, and until there's something so compelling, they have to go for it.
Right. Yep. Let the market come to you.
Yeah. So I know you're only 38. But you have a lot of wisdom, Alex. I appreciate you coming here and sharing it with the F.A.C.E community. You want to show your website where people could follow you?
Sure.
It's at Macro Ops on Twitter, everyone. And this is where you could find Alex's website.
Macro-Ops. Follow me on Twitter at the same handle, Alex at Macro Ops.
Okay.
And yeah,
you want to show it?
Oops, yeah, this is it right here.
Okay.
So there you go. This is the site. Come check us out. Say hello. Yeah, thanks for having me on, Dale. Always a pleasure.
Okay, I'll get in touch with. Yeah, I'll get in touch with you, Alex. Have a, always root for you. Have a great rest of the spring trading season, and we'll talk again this summer.
All right, sounds good, brother. Take care.
Good luck. Good hunting. Yep. God bless you too, bro. And remember, everyone, don't just count your pips, count your blessings, and be patient, please. Okay, you don't have to make your broker rich. Make yourself rich. Adios, everyone. And you could join the team in 16 minutes on the Morning Edge. I'll see everyone. Bye-bye. Thanks, Alex.
Thanks.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.